Okay, so we're here this morning, cooked up some oatmeal, and now the kids are enjoying some hot oatmeal over the fire that they made. They've pretty much done this themselves this morning, other than getting the stuff together, which I took care of. But they are now enjoying their oatmeal. It turned out pretty well. What do you guys think?
Yeah, good.
Got some thumbs up on the oatmeal. So that's a good morning breakfast. We'll finish this up, put the fire out, and then probably head out for the day. Now that we have finished up breakfast, the kids headed back up towards home, and I stuck around down here to wrap up this last section of the income statement. So without further ado, let's get started. So what we've talked about so far is large portions of the income statement. We've kind of come down, we walked through pretty much the whole income statement right up to the last line item in the income of a presented income statement, which is earnings per share. Now we're going to talk about some of the accounting reporting changes, like how does that impact the income statement? And then we're going to deal with the retained earnings and statement of stockholders' equity kind of at the very end of this segment. So reporting of accounting errors and changes. So we have, first of all, we'll start with changes in accounting principles. That means FASB, that we've talked about in other videos, FASB has actually changed the accounting for something. So let's say that they went and eliminated the LIFO inventory method, or they went and required fair valuing of some of your financial assets on a continuing basis, or they disallowed reporting gains and losses on available for sale securities through comprehensive income. Any number of items the FASB may at some point in the future change the way they account for it. So the question is, how do we deal with this? It changes our net income in this period. It would have been different in prior periods had we had this accounting standard as opposed to the one we actually implemented. So how do we handle that? We do that through what we call retrospective adjustment. So we recast prior periods to reflect the change in the accounting principle. So we treat it as if that accounting principle had always been in place. Now, this is for all the financial statements or all the income statements that are reported on that statement. Typically, that's 2 or 3 years. I believe for public companies, they're required to disclose 3 years worth of income or earnings statements when they're in their audited financial statements. So if you would recast this year and the prior 2 years net income to account for that change. You would say, okay, what would net of income have been last year and the year before that had we implemented this principle then? Had we done our accounting this way then, what would our net income have looked like at that point in time? This is called retrospective adjustment. Now, the cumulative effect of everything just gets put into retained earnings. That should kind of go without saying, because that's where all that previous net income that we just retrospectively adjusted for, that's where all of it ends up. So we're going to treat it as if we had this accounting, we did this accounting treatment always. What was it? Always. And any cumulative effect of that, which is usually just associated with the assets that are still in the balance sheet, so it's actually not as arduous a task as you might think, that all ends up just stuffed into beginning or opening retained earnings, as if we'd earned it and it went into retained earnings, or if it caused a reduction in prior income, it would reduce retained earnings at the beginning of the period, and then we would add in our current net income, take out dividends, ending up with ending retained earnings every period that we report. So this approach, it preserves comparability across years within the statements, so that when I look at a set of financial statements for the company this year, we report, say, 2017, 18, and 19, or 18, 19, and 20, depending on what years we're looking at. Those years are all being presented with under the same accounting principles. So any accounting principle change gets retrospectively adjusted into all the prior periods that it affected. So that is how we deal with changes in accounting principles. Now, if we have an accounting error, let's say management messed up their accounting. They didn't account for something correctly. They made a mathematical mistake, or they misapplied some accounting standard, or they just missed something. They just messed it up. Well, those have to get treated, or they're treated as prior period adjustments, in the sense that we have to find out, okay, well, when did the error occur? Let's fix it. We have to fix the error when it occurred, and then everything from there on out gets changed as if the error never occurred. So if you catch the error, well, first of all, if you catch the error in this year's, before you issue this year's statements, then there was no error. You caught it before you issued the statements. So that's a moot issue. But let's say you're preparing this year's financial statements and you looked at last year's and you're like, oh, we made a mistake, or management made a mistake in this area. What do we do now? Well, you need to go back to last year when the mistake was made and fix it there, which will possibly, in this, we're talking about net income or income statement, it'll change net income for that period. It'll then change your opening balance this year of retained earnings, because net income goes into retained earnings. So it needs to get fixed in the prior period. What you don't want to do is take an error that occurred in a prior period and put it into this period's net income. So let's say last year we overstated inventory, which would have caused a higher net income than we should have reported. So we overstated inventory, overstated net income last year. This year we find that error, and let's just say we fixed it in this year's financial statements. That would actually lead to this year's financial statements being wrong. We would be under-reporting income in this period in the process of fixing last year's error. So we fix errors by going back and adjusting them when the error took place. If the error took place before the income statements that we are reporting, we make the adjustment to opening or beginning retained earnings in the first period reported. So that's how we handle errors. Now, similar to errors, we can have changes in accounting estimates. It's similar only in the fact that you're changing something that you had in the past. The accounting for it is totally different. An estimate, if the estimate was reasonable based on the information available at the time the estimate was made, it's not considered an error. It's just a change in the estimate. So if last year I estimated my accounts receivable or my allowance for doubtful accounts on my accounts receivable, if I estimated that at $100,000 and it turns out it should have been $120,000, well, it's not an error in my estimate last year. Last year, I made an estimate based on the best available information, and I reported it that way. The fact that the future turned out different than my best estimate is not uncommon. It's actually very common. If accountants had the ability to predict the future, they could make a lot more money doing something other than financial accounting. They could say pretty much anything where you can predict the future is beneficial. So if it's just a change in the estimate, we don't treat it like an error. We treat it what we call prospective adjustment. We just change it going forward. Now, if it's something like a bad debt expense, that just means we just true it up and we treat bad debt expense like we would in the current period. It's no big deal. It's not an error. We don't change it last year. We just take it into account this year. So net income, let's see, I had bad debt expense that I underestimated last year, which means my net income this year would actually be lower by that $20,000 difference. That would be the prospective adjustment regarding allowance for doubtful accounts. Now, it can have longer term implications. Let's say that we change the useful life of an asset. So if I had an asset, say a $10,000 asset that I estimated was going to last for 10 years, so, and straight lines, no salvage value. So I'm depreciating $1,000 every year for the next 10 years. And let's say 5 years into it, the net asset value is now $5,000 instead of 10. I have a $5,000 net asset value, and I estimate, well, I thought initially it was going to be 10 years. It's actually going to be, let's say, 15. So I'm now sitting in year 5. I've been depreciating it, assuming that it has a total of 10 years instead of 15 years. Now, in year 5, I'm going to change my estimate of its useful life to basically having an additional 5 years. So from year 5, I now have 10 more years to go. So I'm going from 10 years to 15 years. I'm already at 5. I don't go back and change the depreciation I've taken over the last couple of years. All I do is say, okay, the net asset value is now $5,000. I was depreciating $1,000 a year, which would end in 5 years. It now needs to end in 10 years. So I have $5,000 left to depreciate over 10 years. Instead of depreciating $1,000 a year, I'm going to depreciate $500 a year over the next 10 years. That's because I changed the useful life of the asset. And now I'm changing my accounting for it, or my estimate of the depreciation going forward, because I've extended the life of it. I now get to reduce the depreciation I take on the remaining asset value. That's how we deal with changes in the accounting estimates. Big important thing here, estimates are viewed differently than errors. If you make an estimate that doesn't turn out to be correct, it's not wrong, assuming it was made in good faith at the time. You can have a fraudulent estimate, which just means you knew it was wrong at the time. But if you made an estimate in good faith and it turns out to not be that's not the way the world worked out, that's not an error, it's just a change in the estimate going forward. So that's how we deal with changes in principles and errors. Moving on to the preparation of the retained earnings statement. The retained earnings statement, it's just a roll forward of retained earnings. It's straightforward. What a roll forward is, you take the beginning balance, you account for all the things that impacted it, and end up with an ending balance. You're rolling it forward by showing what happened in this account over the period of time. Retained earnings is very straightforward. There's usually only two things that affect retained earnings: net income and dividends. So a roll forward of that, you're going to start with beginning retained earnings. Let's say beginning retained earnings on January 1st is $500. I'm going to add net income to that of $150. So now retained earnings would be $650, but I paid $50 of dividends. So I take $50 out. I had $500 plus $150 minus $50 gives me ending retained earnings of $600. That's just a roll forward of retained earnings. That's the retained earnings statement. Very straightforward. Pretty much all of your equity statements, all of your equity accounts, when we get to this statement of stockholders' equity, are essentially just roll forwards. We're just showing what was the beginning, what things changed over the course of the period, and what's our ending balance. Things that increase retained earnings: net income, changes in accounting principle and prior period adjustments. Like we talked about before, changes in accounting principles and prior period adjustments, as we just mentioned, can affect beginning retained earnings. So those could be increases in retained earnings. Now, decreases, we have a net loss, that would decrease retained earnings. Dividends decrease retained earnings. And the same thing, changes in accounting principles or prior period adjustments would also decrease retained earnings if they led to a decrease in retained earnings or decrease in prior period income. So that is how the retained earnings get statement, or retained earnings get presented. Now, we do have to disclose separately in the financial statements that if there are restrictions on retained earnings. So if management or the board has designated some restrictions, i.e. these retained earnings cannot be paid out to investors, that needs to get disclosed in a note to the financial statements as a restriction in retained earnings. Otherwise, the presumption is that all retained earnings are available to the equity common stockholders or the equity investors in the company. Moving on to comprehensive income. Comprehensive income. This is a very new statement for most students. So most students have taken principles of accounting. They've at least seen income statements. They kind of know what they look like. Comprehensive income is usually pretty new. Comprehensive income. First of all, comprehensive income is all changes in equity during the period except those resulting from investments by owners and distribution to owners. So anything that affects equity that's not to or from an owner is comprehensive income. That means it includes net income and it includes other comprehensive income. I love comprehensive income from an accounting standpoint. It's beautiful. It shows the creativity of accountants when they name things. Like we have retained earnings. Well, what's retained earnings? It's the earnings you retain. Well, comprehensive income, what is it? Well, it's the comprehensive income, like the one that includes everything. Like it's comprehensive, right? That's why we call it comprehensive income. So, okay. What's in comprehensive income? I know there's net income. I know what that is. We just walked through the income statement, how you get net income. What else is in there? Well, there's net income, and then there's the other comprehensive income that goes together. So you have net income, then you have other comprehensive income. It gives you total comprehensive income. So other comprehensive income is the new piece. Most people are familiar and comfortable with net income. Other comprehensive income is other stuff. It's all the gains and losses that bypass net income, but they still affect equity. Back to this idea, we just kind of looked at retained earnings, which aren't affected by comprehensive income. By the way, that's retained earnings. There is a whole account called accumulated other comprehensive income, which is the other piece of other comprehensive income. So these, again, other comprehensive income are all gains and losses that bypass net income but affect stockholders' equity. Comprehensive income is both net income and other comprehensive income. Those two components make up comprehensive income. Some examples of other comprehensive income: currency translation adjustments. So if you are, let's say Walmart, because that's who I've been using a lot in the income statement discussion. Let's say you're Walmart and you have operations in Germany. Well, guess what? In Germany, most of Walmart's transactions are denominated in euros, not dollars. However, the financial statements of Walmart are presented in dollars. Okay, how do we get from euros to dollars? Because it's all dollars, it's all euros. Oh, well, we'll just translate it because there's a exchange rate between euros and dollars. Yes, great, but that exchange rate changes every year. That's kind of weird. So you're telling me that depending on the exchange rate, the same building that I've done nothing to, one year could get reported at, say, $100,000, and next year get reported at $110,000 just because the exchange rates changed? Well, that seems weird. Nothing else changed other than the exchange rate. Exactly. We don't want that going into net income. Well, we stick it in other comprehensive income. It's just basically taking into account that exchange rates between currencies change. So when you convert something from euros to dollars or from yens to dollars, you're going to end up with variations year to year. That's going to lead to a translation adjustment. That gets put into other comprehensive income. Changes in the value of certain assets also goes into other comprehensive income. For instance, like hedges. Also, the changes in the value of pension liabilities goes into other comprehensive income. Broadly speaking, this is a little bit of an assumption here. Broadly speaking, other comprehensive income, it's called OCI, other comprehensive income captures valuation changes on the balance sheet that don't represent the operations of the company. So when I say don't represent the operations of the company, if you have a bank who has a bunch of investments that go up in value, well, as a bank, your job is to invest money and make money. So that increase in valuation is part of your operations. However, if you're Walmart and the value of your land in Germany went up because the currency changed, you don't want that going into your operations. You stick it in other comprehensive income. So in general, OCI is capturing fluctuations in the value of assets on your balance sheet that you don't want to pass through into net income. In general, these are temporary in the sense that once they get settled, other comprehensive income translation adjustment goes away because now we're dealing with cash. Once you have assets that go away, it goes away. It changes it to put into cash. So that's other comprehensive income. There are two ways to present other comprehensive income. One, a single continuous statement. So this is a one statement approach. It just lumps in, you start with revenue, you end with comprehensive income. Net income is right in the middle of that whole statement. So you start sales, ends with comprehensive income. That's a single statement. You can have two separate statements, in which case you have your income statement, which starts with revenue or your sales and ends with net income. And you have a second statement called the statement of comprehensive income. It starts with net income and it ends with comprehensive income. So it breaks everything down into two different groups in that case. So those are the two different ways it's presented. Most companies are using the two-statement approach, and that's because they want to separate out their other comprehensive income from net income, and they want one statement, their earnings statement, to end with net income, not have to have people dig through a statement and find the one line in the middle that says net income. So most companies are using two separate statements for that. And that's what Walmart does. That's what most public companies how they're going to present it. So that leaves us off with the statement of stockholders' equity. The statement of stockholders' equity reports the changes in each stockholders' equity account and total equity for the period. This is, again, it's just a roll forward of all the equity accounts. So common accounts, stockholders' equity, additional paid-in capital. So additional paid-in capital is the amount of money paid in addition to the par value of the common stock. Par value is usually something ridiculous like 1 cent per share. Everything in addition to 1 cent, most stocks shoots to IPO, let's say between $20 and $100 a share, depending on the company and whatever people are feeling that day. Anything in addition to 1 cent goes into additional paid-in capital. The reason for there being two accounts has to do with legal criteria and basically legal stuff associated with the dissolution of a company that we don't need to get into in accounting. So there's two accounts. You have common stock, which is just the par value of the common stock times the shares outstanding, and you have additional paid-in capital, which is the amount paid in addition to the common stock number. That's what you have. As soon as you start a company, you collect equity from your investors. You have common stock, additional paid-in capital. Now, as you operate as a company, you're going to earn money. Those earnings are going to go into retained earnings. Like you're going to retain some of those earnings, you put them in retained earnings. And you're also typically going to have an accumulated other comprehensive earnings account or accumulated other comprehensive income. These are the things, net income goes into retained earnings. Other comprehensive income goes into accumulated other comprehensive income. It's an equity account. All those valuation changes that we just talked about, currency translation adjustments, they go into your accumulated other comprehensive income account. So you end up with a statement with a bunch of columns. Usually it starts with the shares that are outstanding. So you have a share roll forward as well as an amount associated with the shares. Again, that's your common stock. It's going to be the par value of the shares. You then have capital in excess of par or additional paid in capital, depending on what the terms the company wants to use. You then have retained earnings. So how much of the earnings is the company retained? And that includes, we just talked through the retained earnings statement. This is just a retained earnings statement with a bunch of different equity accounts listed as well. Retained earnings statement. Then you have accumulated other comprehensive income. And that lists all the changes in the other comprehensive income that go into accumulated other comprehensive income. All of those items together give you your total stockholders' equity for the period, and that should agree up to your balance sheet where you report assets, liabilities, and stockholders' equity. So that is how the equity statement functions. So in a quick overview of our income statement, we talked initially way back in the first income statement video, we talked about why we have the income statement, what's it used for, what are some of the limitations regarding identification, measurement, and communication for the income statement, and then some things that affect quality of earnings, basically management's ability to input bias into some of these, which is what we call earnings management. And then we moved on to what are the elements, so revenues, expenses, gains, losses that go into the income statement, income taxes. What are all the different layers? If we walk through an income statement, we start with revenues, expenses, gains, losses, discontinued operations, non-controlling interests, income taxes, interperiod tax allocation, how all of that kind of gets put together. And then we wrapped up this final section by talking about how we account for accounting changes, errors, and our retained earnings statement and our comprehensive income. So that wraps us up for the income statement. With that, I will let you guys go. It was great talking with you. Have a great day and God bless.